Hi everyone, it's Steve here from the Forex Codes. Money Making Indicators Part 4. The TFC ADR Dashboard. ADR standing for Average Daily Range. Now, I will not trade without this dashboard, and here's why. Okay, the average daily range, ADR, is a concept that shows the average pip range of a currency pair over a specified period of time. Could be a week, could be a month. Those are the two usual variables, a week or a month. And to calculate the ADR value, you just need to get the daily high and low of every trading day for the specific period you're using. So you would get the daily high and low, subtract them, and that's your number of pips for that day. If you do that over 5 days, add them all together, divide by 5, and that's the weekly average daily range, for example. So it's straightforward. If we look at the chart here, let's go from it goes from 12 o'clock to 12 o'clock, so that's the high of the pound today, that's the low of the pound today, 71 pips. There you can see it anyway. Today's range is 71 pips. So if it was 70 pips and tomorrow's is 90 pips, then the average daily range over 2 days is 80 pips. Get the idea? So the periods we use are the 5-day for the weekly ADR, which we call the WADR, weekly ADR, and 20 days for the monthly ADR, or MADR. Simple stuff this, isn't it? And the average daily range of a pair will usually be completed between halfway through the Asian session and the end of the London session. Usually. There are some exceptions. Thursday evenings sometimes, Fridays sometimes, but usually between halfway through the Asian session and the end of the London session, the average daily range of a pair is usually completed. And the ADR is a measure of volatility, and this changes over time. For example, if the ADR of the pound is 200 pips this year, last year it might have only been 100. Volatility changes over time depending on what's going on with the currency and the fundamentals of that country. So volatility, if something's got a range of 200 pips, that's more volatile currency than a currency that's got a range of 50 pips. Okay? And studies have shown volatility, that the level of volatility tomorrow is likely to be close to the level of volatility today. That's not always, nothing in Forex is always the case, is it? Otherwise everyone will be winning at it. But in general, today's volatility is usually the same as tomorrow's volatility, unless there's a big news event. Okay. The ADR is very useful, but it's often overlooked. Do you know, I bet 90% of traders don't even use it. But it can determine many things, and I don't trade without it. It's just a fact. It can tell me which currency pairs are worth trading, because if a currency pair is trading and its ADR has already gone or is close to its average daily range, there doesn't seem to be any point in trading that currency to me. So we can tell which currency pairs are worth trading. And also you might want a low volatility pair. Well, the ADR is going to tell you which pairs are low volatility, which pairs are high volatility. Number 2, whether it's probably too late to find a high probability trade entry. That's similar to the first, but if much of the ADR is gone, you're not going to find a high probability trade. It's also useful for when a good entry opportunity has come. For example, you might have TFC Candles and Wave pointing up, fantastic, all green. Your Cloud's all green, your Trix are green, you've got a Squeeze firing off to the long side. Now, if the average daily range of that pair that you're thinking of trading is 200 and the range so far is only 100, then you've got a lot of confidence in taking that long trade. Okay? And when to exit a profitable trade. Let's say in a trade and it's 40 pips up and it's very close to or hitting its average daily range, it's pointless trying to get 50 or 60 pips out of that. You might do, but it's not high probability, is it? So let's have a look at some uses. I trade intraday, so I need to know what the ADRs of the currency pairs I'm trading is. This is because I always want to know how much further a pair can realistically move given its ADR compared to today's range. Is there much left? This information is useful for profit targets and for stock placements. You know, many a times I've looked at a pair at say 3 o'clock in the afternoon, Greenwich Mean Time, 2 hours before the London close, and let's say its average daily range is 100. Sometimes it might have only done 40 or 50 pips, and I'm thinking, this currency pair is going to do a run to its average daily range, long or short, and I use my TFC indicator to tell me which way it's going to run. These are days I really do like, because I know you're going to get a run. So if the ADR of say pound New Zealand is 180 pips, pound New Zealand is very volatile, and at 1 PM GMT it's moved only 90 pips, then the chances are another move of size is still to go, usually with the trend, unless of course there's a news event, but usually with trend. And we can use this to our advantage in trading if we know there's likely to be another big move. And this is because, as I mentioned, once a day at least, but certainly once a day, a currency pair will make an extended run towards its ADR. And if it hasn't done it yet, use the Forex Code systems to tell you which way it's going to go. And of course we just need to decide which way. TFC strategists will tell us. So, for the sake of repeating myself, let's say a pair like the Euro Yen has an ADR of 120 pips, and during a given day it's been trading at the top of its range, so it's already gone 120 or close to it. With the session end approaching, it would not be prudent to open a long position, because this would not be a high probability trade because it's already covered its range. You're asking for something that isn't there. Could it be successful? Yeah, but most of the times it's not going to be. So in addition, if the ADR is greatly exceeded in an extended move, let's say the ADR is 100 and it's already now at 150 for that day, something's got to give, hasn't it? The ADR is greatly exceeded. Then watch for a pullback back to the average range area. We call this elastic band effect. I'll come on to this a bit later. Imagine stretching an elastic band, what happens when you let go. And this is sometimes good for counter trend trading after London closes. If you've got a pair that's massively exceeded its range, it's going to pull back close to its average range again. And if it's gone long and there's some resistance up there, these are good for counter trend trades. There's no point holding a day trading position beyond the average daily range of a pair, either in the positive profit target or in the negative stop loss direction. I think that's pretty clear. And if the average daily range for the euro pound, for example, is 75 pips, then there's no point to shoot for a target of 100, Now some people do, because they shouldn't be trading. They don't have the education, they don't have the training. So you wouldn't shoot for a target of 100 pips in a day trading position, because most of it might not reach 100 if its average daily range is 75. It's just rank stupidity, really. So how do we calculate ADR? I think I've mentioned it. For the weekly ADR, WADR, add the last 5 days high minus low and dividing by 5. For the monthly ADR, MADR, just take the last 20 days high minus low and divide by 20. It's rocket science, isn't it? The following table, this is January 2019, shows the ADR values in pips and pound value for one lot traded on some of the major pairs. I've only put some in. So Aussie yen, 109 pips. Euro yen, 120. What are the low volatility? New Zealand dollar, US dollar, only 54. The euro dollar's been very calm of late, 69. Euro pound has been a bit more volatile, 74, 75. That's because of Brexit. So let's talk about the dashboard itself that sits on the chart, and I will show you a diagram of this shortly. Let's just get some of the theory out of the way. This indicator, it's a tool to make your life easier and stop you taking trades that you shouldn't take. You know, if people stop taking bad trades, you wouldn't have 90% of losers, you'd have about 30% of losers, because they've cut out the bad trades. So it makes your trading life easier to enable you to make quicker and more informed trading decisions. This is what it's about. It sits unobtrusively the top right hand of your main chart, and it forms part of your trading toolbox along with TFC Candles, Wave, TFC Cloud and so on. And the first part of the dashboard reminds you of the currency pair. Again, I'll show you a chart of this in a second. You're looking at, see image coming up, and right beneath that is an ADR calculator, and this calculator contains several things. Not the best slide in the world, but we've got the TFC dashboard. This is euro pound recently. Today's range so far, TD is today's range. Today's range so far is 66. Yesterday, YD is yesterday's range. Yesterday it did 55 pips. The weekly average daily range is 64. And the monthly average daily range is 75. So today's range is close to its weekly, and it's not far away from its monthly average daily range. Yep. Room up and room down, I'll come on to just a bit later in the presentation. But this basically tells you from where the price is now, where it is now, how much room up you've got until it reaches its daily range, and how much room down it's got before it reaches its daily range. This is very useful to know. So I'm going to reiterate, because this is important. TD, today's range. Now the background colour for this is normally yellow, but changes to blue when the pair has reached a range of 35. Certainly for the pound dollar, euro dollar and others, I like the higher volatility ones. I like to see at least a range of 35 before I start trading. Then I don't get into any sideways trading. But the TD point will change to blue, like here. If that's under 35, that's yellow, but it turns to blue when it gets greater than 35. Okay? This is designed to prevent you from trading in a choppy market, the 35. But obviously, let's use a bit of common sense. If you're looking at a currency pair that only has an average daily range of 50, then forget the 35 pip rule. YD is yesterday's range. If yesterday's range is large, often today's range, what I mean by large, I mean extended, then today's range will be a lot smaller. And conversely, if you've had a couple of days of low ranges, it's possible a large range is coming. Does that make sense? So the weekly average daily range, WADR, is calculated over 5 days. So it's important when you're looking at your screen and at your charts that you compare today's range, how many pips today the market has gone, the currency pair has gone, and compare it with the weekly average daily range and the monthly average daily range. We've just been through that. So the MADR, monthly average daily range, this is calculated over 20 days. And if you compare the WADR to the MADR, you can tell whether the ranges are contracting or expanding, yeah? Contracting ranges will eventually burst out and expanding ranges will eventually become less volatile. That's over time. Room up, room down. This tells us how far today's range, TD, has to go to get to the ADR. So if you're looking at, because you might say, well, how much, if I'm taking a long trade, how much room up is left? If room up is saying there's 40 pips before it gets to its ADR long, you might say, yeah, I can go for a 20 pip trade. Conversely, if you're looking at a short trade, you might say, right, let's have a look at the room down. If the room down is saying 10 pips, and you want to go for 20 pips, it's not a high probability trade, is it? So room down and room up is important. As I've just said, and ahead of myself, if the pair is in an uptrend today and the room up figure will decrease until it gets to 0, which means today's range equals the average daily range. Now, this is important. If today's range exceeds the average daily range long, then the room up figure will be negative. Example, if the average daily range, or the weekly average daily range, is 100, and TD, today's range, gets to 101, the room up figure will go to -1. Okay? Now, if you've got a minus room up figure or a minus room down figure, you don't want to be trading in that direction, do you? And if you turn the alarms on, it'll sound an alarm as well. Oh yes, we've got all the mod cons here. Okay, still on the room up, room down. Conversely, if we're in a downtrend today, the room down figure will decrease until it gets to 0, meaning that today's range is equal to the average daily range. By the way, I might not have mentioned this, let's mention it now. What do I mean by the ADR? Well, the room up, room down uses the figure of the weekly average daily range plus the monthly average daily range divided by 2, and then it calculates the room up, room down figure. So write that down, and if it doesn't come to you straight away, just re-watch this little bit. So if today's range exceeds the ADR short, then the room down figure will be negative. It'll turn red and sound an alarm. So for example, if the average daily range is 100 and this currency pair falls 100, in other words TD equals ADR, if it goes another pip short, the room down figure was -1. So when using the Forex Code strategies, if today's range is within, say, and you can be flexible on this, depends what time frame you trade in, but if it's within about 15 pips of the ADR, if today's range is with about 15 pips of the ADR, then it's unwise to trade in that direction. In other words, if room up is less than 15, don't take another long. If room down is less than 15, don't take another short. Yep. But people don't pay attention to this. They go blindly into the wild and lose the money. So as I said, if room down is less than 15 pips, you wouldn't take another trade short. And if you were already in a short trade, you might want to get out, or close to it, or do a partial exit and then wait for room down to get to zero. Yeah, does that make sense? If you're in a trade and it's getting towards its ADR, watch the room down figure if it's short. Let's go live to the charts. Straight in there and look at the pound New Zealand dollar. Let's take a look. So pound New Zealand dollar, you can see that today's range is 201 pips. Yesterday was a big range as well, 227. The weekly and the average monthly, average daily, the weekly and the average daily range is about 172, 173. So where the price was when I took this picture, the room down was -20. In other words, the ADR is exceeded by 20 at that point there. So obviously you wouldn't trade short. You might have trade short up here knowing there was still a bit of room to go to the ADR, but as it got down to this 50 line, you would have been going short after that. So there's an example. This is Euro Aussie. That's not massively clear, but the monthly average daily range is 135. But the weekly average daily range is 85. So this week, for some reason, the Euro Aussie ranges have contracted, yeah? Seriously contracted by an average of 50 pips. Low volatility this week on the Euro Aussie. It could signal, remember nothing's 100% in Forex, but it could signal a big move to come, high volatility. Or it may be the price, the volatility is changing on this pair. That might be unlikely, but I would watch out for a big move in the Euro Aussie coming up. And if we do get that, I'll come back to you on it. Look, today's range is 76, yesterday was 114, but the monthly average is 135. The weekly is a lot less. Okay, and there you get the room up and room down figures. Loads of room either way if you're taking a long or a short. So in the next slide, the ADR of the euro dollar has been exceeded long, and room up is showing -17. Okay, and price is heading towards yesterday's high. So longs are out the question here because it's heading for yesterday's high, which is going to be resistance, and the room up is -17, so it's exceeded its average daily range by 17. So a bounce off yesterday's high is a possibility with the tight stop above. And you can see the euro's on a roll. There's yesterday's high. We've exceeded the ADR and we're heading towards yesterday's high. See, the monthly's 68, the weekly's 54. You had a good long range yesterday and you got another long one today. So you wouldn't risk taking longs. I mean, it could work. You know, Father Christmas could be real, but it could work. But why take it if you've got this knowledge that it's exceeded its daily range and you've got resistance here? That's just another example. Let's talk about the elastic band effect. Remember earlier when we said that if the ADR is greatly exceeded in an extended move, then watch for a pullback to the average daily range area, average range area. So if you imagine you've got an elastic band in your hands and you're stretching it and stretching it and stretching it, what's it going to try and do if you release the pressure? It's going to try and spring back, isn't it? It's the same with the next extended move. If the average daily range is 100 and it's gone 150, it's going to try and spring back. This is sometimes good for counter trend trading after London close. It's like an elastic band when overstretched, and a stretched ADR has the same effect. So this is recent. The ADR on the euro yen today was exceeded by 34 pips. Yep. It's 39. Average daily ranges. The monthly is 105, but the weekly is only 57. So you've got a real move today. And you can see price does come back, and this is only today, to the average daily range, which is at yesterday's high. So it does go through that, but the elastic band effect, it comes back. So if there's resistance up here or anywhere up here, you can take a counter trend trade because of the massive extension to the average daily range, yeah, and get yourself 10 pips maybe. I wouldn't go for any more than that, but you would have done today. You'd have got a lot more. But see, price comes back to the ADR. So I'm sure you can realize the value of the ADR, and when you start using this, you're going to be thinking to yourself, you know, how did I ever manage to trade without it? Because this is information I'm sure you'll agree that you need to know. The ADR. Okay, folks, again, please spread the word about this channel and the Instagram. I do something every day on Instagram, usually a 1-minute video of a trade, and that's, you can see it on the screen there, at the Forex Codes. We've also got the website, and we've got facebook.com, the Forex Codes. So share this, like the video, and remember, how you do anything is how you do everything. Okay, folks, take care.